Yes, today is 14th of November 2018. So there's something that last week I also looked at how to trade the aftermath of US midterm elections. So what we came up with from that webinar was that we are not trading politics. That's what we, the first thing. We are not trading politics. We're not trading politics. This is what we wrote down. That will not trade politics. Actually, it was any news relating to politics. Any news relating to politics. Any news relating to politics. Then he also said that if the news relates to interest rates, relates to interest rates, interest rates and earnings, then we'll trade it. So looked at last week on Wednesday, we actually said that any news that relates to politics, we are not going to trade. But then if we find news that relates rates and earnings, that the very to know that you have to have a good strategy. You cannot trade without having strategy to trade. There's nothing that works without a proper strategy. Like this is a chart where you come to this chart. There are several other strategies which you may want to use. One part said that this case we'll use MACD for the start. Then we bold it and then we add it. In this case, he'll pick a sell point. Then if price goes above it, then he'll pick a buy. This is an example of it. We also have, in this case, he'll also say something like this. Something like this. Like this. So in this case, the price has gone below. We see that this previous candle was above, previous column was above 0.00, and then the current one is now closing below 0.00. So it may say that as long as the price is below 0.00, not price actually, the columns of this MACD are below 0.00, is selling it. Then the day they break above, he buys it. Then another strategy could be like this. Someone may also be trading crossover, like he'll come to this place, insert indicators, and then go to trend. Then there's this moving average. He may have 52 moving average, like that. Then he adds another here, moving average, and then this one should be 152. We give it a different appearance. So this is the second one. We should write sample strategy where we say that the first one is when MACD crosses 0.00, then number 2, when MACD crosses above 0.00. So this is one strategy, and it relates to MACD. You only buy when the columns of MACD rise above 0.00, and only sell when they go below 0.00. That's what I've just illustrated here. There is this line. You see, from this point to this point, the price was below 0.0. So the instant when the price now rises beyond 0.00, you'll take a buy position. And then we do the exact opposite when it goes below. Like in this case, the price went below, the columns went below 0.0, so this is a sell. And then the next one here, there's a cross above, we buy it. Then price again goes below, we sell it. So what this strategy says is simple, that if as long as the price is still below 0.00, like the column not price, the columns are below 0.0, like in this case we have 0, below 0, below 0, below 0, below 0, below 0, we are actually selling it. What we do, a sell, and a sell, and also a sell. Then the time when price breaks above 0.00, then we look for a buy. Every instance, the first can closes, and then the columns of market 00, we buy it. Then we also buy here. We may also want to buy it anywhere, just anywhere, as long as the columns of MACD are above 0.00. And we'll do the exact opposite when the price is below, something like this. So this is simple. Anytime the price begins to cross below 0.00, we look for a sell. But then the time it crosses above 0.00, we buy it. We could buy it here, and then we will also buy it here, and then we'll sell it that and it went below. Then we'll also sell it here. So in this case, you'll see from this day, which is 11th of July, we'll have this one trade. We have that one trade, one sell trade, then you have another buy trade, then you have another sell trade, then you have a buy trade, then there's a sell trade, then there's a buy, and then we sell it. So what this strategy says is simple, that bought in this and the price has gone up, then you only get out when there's something opposite happens. Like in this case, when the price now goes below 0.0. We can see, like in this case, the price went below, and then if I sell here, then I only get out when the price now rises again above 0.00, something like this. So this is one simple strategy. And from the point number one, we've said that the most important thing, you have to have a fully defined strategy. And then this is the sample strategy which I've just illustrated as one strategy. And then there's another one which we look at, which is called crossover strategy. This is basically based on moving averages. And it says that anytime a slow moving average goes above the fast moving average, we are looking for a sell. When the slow moving average goes below fast moving buy. So this I want to let's say the second simple strategy is called crossover strategy. So in this case, we have two moving averages. We have the first one, Actually, the slow one is the one that has the maximum period, and then the fast one is the one that has the less period. If you double click this, you'll see the period is 52 in this case. Then so the one moving average, you're supposed to look for a sell. So we need to find that. And just a second, I find a good place for us to look for that trade. In this case, we have this one. In this case, we have this candle here. We have not candle, this average. The fast moving average crossing below the slow moving average. So you're supposed to look for a sell instantly when this happens. Like this. And do exactly opposite. In this case, it's a simple strategy. We say that a reversal, like the fast moving average now gets above the slow moving average, you look for a buy. But then when the opposite one happens, where we find the slow moving one now gets above the slow, and then you're supposed to be selling it. Another example we have here, where the slow average 152, it gets below fast moving average, and you're supposed to look for a buy here. Then we also have this case here. We have the fast moving average getting above the slow moving average, so that's a buy. So as you can see, this is just a very, very simple strategy, and if you see it, you see that every time there's this crossover, the price tends to move towards that direction massively. There's that move upwards, something like this. Point up. Then we have this crossover not and ended up crossing again from this. So as you can see on this chart, we could have sold here, somewhere here, but then the price ended up crossing again on this side. So this was a loss on our side. Then we also bought it from this point because there's a crossover to the upper side up to the point when the price now crosses again to the other direction. So this the price went up, came down, went up, then down, up like that, and then we closed at this point with a small profit. So there's also this buy here that went correctly here. We buy after crossing. We have this one. So if you bought it there, the price actually went up to this place before retreating back to the lower side to this place here. So this is just a sample strategy, a very simple. And from what we just said from the first one, that you we just so you need to know what crossover. You have to know that every last one like this, we are looking for a sell position. But then when the slow moving average goes below, moving is supposed to look for a buy position. So that is that. So now we have a strategy. We'll use this on crossover. We'll use that to explain the remaining ones. We now have a strategy. We said that you're supposed to buy every time the slow moving average goes below the fast moving average. So there's something you need to attach to this one to make it much better. You can see, like in this case, the price went up to this place, but then it came down to take away the profit which already earned. We don't want this to happen. So to avoid this, you need to have some fixed take profit, maybe somewhere here. It could be any figure, just anything of your own choosing. You say that anytime the price goes your way, like maybe 100 pips should here, you get out. You simply say that if you bought here after this crossover and then the price goes your direction maybe for 100 pips, you get out. And then if it goes against you for 50 pips, you now also stop. That is called loss and take profit. So here we say that must take into account the risk management. So any strategy you have, whether it's this one or breakout strategy, all of them you must have a clear defined risk management. You have to know that how much are you risking and how much are you willing are you going to get from the trade. Then a good strategy must be in line with the long-term trend, something like this. We need to check this daily chart. So assuming you're looking at 15 minutes chart on you're 15 minutes chart, the same pair, 15 minutes on crossing low the fast moving average, which means you're supposed to be buying it. So you come here about to buy here, but then when you go straight away to the weekly chart, not weekly, daily, you realize that there's a sell. We have the fast moving, the slow moving average being above the slow one. So the slow one being above the fast one, this is a sell. So if the daily is showing you a sell, but then you're seeing a buy on the 15 minutes chart, you don't do anything. If daily is a sell, I'm supposed to look for a sell on the 15 minutes. That's what I meant when I said that it must be in line with a longer time frame. So this strategy, the one I'm using, the crossover which I've just selected, you need to come to your chart properly here. You get to this chart. Let's clear this object. You get to this chart. Then you first of all check on the daily. Are we selling or we are buying it? In this case, there's a sell. We see that there's a cross, which means you're supposed to be in a sell now already. So if somebody sold on the daily chart, you who is doing 15 minutes should be looking for a sell also. You don't want to buy anything against what the person doing daily is doing. And then there's another thing which you need to put in here, that your key levels also must be in line with the long term. Like if this is a daily chart, in this case, then I'll come and pick these places and have my lines there, and also have somewhere here, like that. Then maybe I'll also have a line here, somewhere here. This is just a resistance, then this is just a support, then you also have the top one, which is also just a support. So there is this place that we have, this being a sell place. We sold it from this place, we are still holding on to that sell. So assuming you sold it here, then the price went down, came up, then down like this, it keeps going and then coming back up. So you need to mark these resistance places, and if a cross happens on a lesser time frame while the price is around these places, you now sell it, something like this. So assuming you sold from this point or you didn't sell it, comes down, goes up and establishes this resistance, goes down again, the best you should do is to wait for price to come back to the same place, then you sell it downward. So if you're trading and the same cross happens around this place within this zone, then you sell it. Or if it happens slightly below it, you're supposed to look for a sell. So what that means is simple, that you are trading crossover. The best you do, you start from a higher time frame. You analyze everything you're doing from the highest point of view. You'd come to weekly chart and then look if there's a sell or a buy. If there's a sell on the weekly chart, you now go down to lesser time frame and look if there's the same sell. And to get the best sell places, you go for key levels. Key levels are like this resistance line. We have this resistance, then we also have this resistance. We also have this resistance. Yes, so the first one, the second one, the third one, the fourth one, the fifth one, and also this as a good level. So if the price is anywhere around these places, you sell it. And the next most important thing, we've already looked at this. Then we've said the last, the strategy. Your strategy should be simple as possible. Should be as simple as possible. Look at this chart, what we are illustrating. We're only saying that anytime there's a cross, we do a trade. We don't know exactly what happens in between. Like, we don't know what happens here, that there's this green candle, there's this red candle. No, no, no. We just don't know. Is there a cross? Yes, we sell it. Then there's another one here. Is this a cross? Yes, we buy it. Simple. Don't have a strategy that's complicated. This, there's a cross, we sell it. In this case, like here, we have a cross, we buy it. So you can see it may not necessarily be very productive, but then in the long run you're going to be good. This is a complete trade you took. Then take profit. Maybe you'll get out somewhere here, or maybe somewhere here, or maybe if it was so much, you're supposed to get out somewhere around this place. Then we also have this which went wrong. We sold from this place, but which somewhere here, we sold here. Sorry. We sold somewhere here. But then in going down, the price went up before eventually coming. So this one, US Pro is saying that we could have let it up to this place where it crossed again to the upper side. But then with a good stop loss, you're supposed to get out somewhere around 50 pips here. Somewhere around there. Then there's also this cross. We also have this cross. The price crossed above this place. And then we bought it the same place. It went up completely before eventually returning to the lower side. So this is what I meant when I said that your strategy has to be as simple as possible. Must be very simple. Don't complicate your strategy. If you find that your strategy is not easy to explain to everyone, then it's not a strategy. You're actually taking advantage of some events in the market. So we need to keep it simple. Like in this case, the price crosses and we trade it. So this is another simple one. Let's look at it. We have another very simple one. It's called breakout, where the price above a level and then it comes up to the same place, then you trade it. Let's check this. Open file location, like that. So these are just some features which I created, and this sample of a strategy. Like you could say that the first thing you get a resistance line, and then the price goes beyond it. Then should the price come back to the same place, you buy it. That's simple. The next one, you establish a good resistance line, could be a support, then another resistance line, then the price goes above it. If price comes back to the same place it's supposed to, this is just a simple strategy. There's also this, where if price has a resistance line, we have this resistance, the price goes down, the same resistance down, same resistance down. So you're supposed to sell every time the price gets to this resistance, you sell it. But then the moment price breaks beyond it, you buy. Resistance line, a resistance line, the price breaks above it, then the day price comes back to the same place, you buy it. So this is another strategy, and it's based on breakout. The price goes above a level and comes back to the same place before we buy it again upwards. Another example, a support. So this is a resistance line, price goes above it, then comes back to the same place, up, then back to the same place, and since this is the third time we buy in the future. We also have another one, this trend line. the same resistance line, the same resistance line, the same one, the same one, the same one. So our job will be simple. We sell every time the price gets to this place, you're supposed to sell it. And that sell has to accompany the stop loss and a take profit. So if you sell here, assuming something like this, assuming I come and sell somewhere here, sorry, assume I sell here, then I'm supposed to remain just slightly to take profit somewhere here, sorry, somewhere there, and then I have my stop loss above this place, and that should be red, something like that. So we don't do, yes, it's the entire move, but then it is take profits. Like you just define it. You say that every time the price goes your way, like 2 times whatever you're risking, you get out. Something like this from this case. Assuming I sell at that point, then my stop loss will be something here. Take profit will be there, something like that. So you are working with very tight stop loss and then let your take profit to run properly. We also have this where we allow our loss there, and then we let the trade run, and then you have the take profit somewhere here. Sorry, somewhere like that. Something like that. So if you sell from this place, then yes, we know where the price is supposed to go down, but then just take your profits here while the profit is there, and then have your stop loss very tight, just slightly above where you sold from. We also have this stop loss, then take profit should be somewhere there, like this, like that. So these are like 1, 2, 3, 4 trades, and then notice we have take profit the same way, take profit the same way, take profit the same way, and then take profit also the same way, and the stop loss is also the same way. We are risking the same amount. So this could be any figure. It could be some maybe 50 pips, 50 pips, 50 pips, 50 pips. But then every time it goes for you, you get 150 pips. This is an example of our good strategy. After you define a strategy, we've looked into that now. Need to save that. Reward, something like that. We check the next one. So yes, this is the next one. So we have this one being as a support, then a support, a support, a support. Then now price approaching the same place. What happening is simple. We want the price to come to this place, then buy side. The best you do here is to wait for a buy, something like this. So someone may say that if you buy from this place, then you're supposed to wait for price to come up to this. Just define your take profit 100 pips, and then you write stop loss just below where you bought from. Then the middle one, this one also you're supposed to buy the same way. Have your stop loss here, and then have it tight take profit, something like that. Stop losses. A very tight stop loss, so take your profit early. Don't let it to run like this. Don't expect that it may go up to this place. Yes, sometimes it may add that. What that means is, okay, then define a place to take profit. It doesn't have to move necessarily up to this place. Like that. We move to the next chart. Just in this case, we have this resistance line, then another resistance line, resistance line, resistance line, resistance line, then another resistance line, then this and then you also take profits somewhere. So this thing you need to know. If you want to have consistent trading, then you need to define stop loss. Then your stop loss must be a constant figure. Like you have to. That is something you need to write down. Then while take profit should be allowed to float, take profit should be allowed to float. Your stop loss must be around figure maybe 50 pips. So this means that every time you trade, you only risk 50 pips. However good a trade is, you're only risking 50 pips. But then take profit should be at least 100 pips. So that is a ratio of 1 to 2 risk sorry 1, you are risking 1, and then for every good trade you get 2. So we are just risking 50 pips, and then if a trade goes our way, we get 100 pips. So maintain this for some times. Like at no instance should you find yourself risking and you get less than that in a trade. It should be 50 again. You understand, then you must take into account the number of pips you are going to get in a trade and the number of pips you are losing in a trade. Then we've said the next one, that you should cut your losses very fast. So I've tried to, this is what I was trying to explain by saying that it's supposed to be 50 pips. What that means is this: you're looking at this chart, then you already place a pending buy limit within this. Then have your stop loss here below it, and then maybe you have your take profit. Then there's also an